Well, as we move on to our next speaker, finding the optimal asset allocation mix in a multi-asset framework. That is the title of the presentation that Sumesh Chetty, a portfolio manager from 91, has prepared for us. Sumesh, thank you so much for joining us this morning. Very much appreciated. I'm sure a lot of investors in South Africa, or South African investors, to be more specific, have a lot of questions. And maybe one of the big questions is, how do you allocate your capital adequately? So I'm going to hand over to you, and hopefully we'll be able to get an answer to that question.
Thank you very much, and thank you so much for having me here today. So finding the optimal asset allocation mix, it's something that we spend a lot of time thinking about. It's at the heart of everything that we do within our portfolios. And I thought I would start very quickly by just touching on how we actually allocate to different asset classes within our portfolios. So what we're attempting to do is we're attempting to balance risk and return. Our intention is to generate real returns on a 3 to 5 year basis, but simultaneously we're looking to preserve capital on a shorter term basis. So depending on where you're invested, it could be as short as over 1 year, it could be as long as over 2 years. And typically the way we're thinking about the opportunity set available to us is on a pure bottom-up basis. So we assess the expected return of individual securities. And we do this, as you can see on the slide, for equities, for bonds, for credit, for property, and for cash. And we think about those various individual securities on the basis of, can they re-rate or derate from current levels? What sort of income are those individual investments going to generate? Is that income going to be growing over the next 3 to 5 years? And very importantly, is how is this particular security impacted by currency? Is it a global business, for example? Is it a pure local business? And that gives us a sense of the total return. Now we aggregate that on an asset class level, and very specifically, that combination depends on correlations or the relationships that exist between the individual securities and the asset classes. So we think about that very carefully. Historically, what does it look like? What does it look like in downturns, for example? And then once we have that particular combination of securities, across equities, bonds, cash, we then shock the portfolio. We test the downside sensitivities, and we look at whether we're comfortable with the expected returns of the portfolio and the risk that we're potentially running. And it doesn't stop there, because we start the process again. So the process is very, very iterative. And clearly, on an ongoing basis, we're doing this because the expected returns from each of the individual securities is constantly changing, and the risks change in the market as opportunities change. Now, I mentioned that we look at the correlation or the opportunity, or the relationship that exists between the opportunities. And correlation is actually very important to us, because what correlation does is it allows you to offset different opportunities. At present, we're very excited about global equities, and we're very excited about South African bonds. And what makes the opportunity even better to us is that global equities and South African bonds actually have a negative correlation. What does that mean? When global equities are doing well, specifically when the rand is weakening, bonds aren't doing so well. Similarly, when global equities aren't doing so well, bonds tend to be doing very well within our country. So we like that offset within the portfolio. We like the fact that those two elements create balance within the portfolio. Now, we appreciate that through time, correlations can actually be quite dynamic, that they change over time. So that's an additional risk that we need to assess when we are constructing portfolios. Now, speaking about the risks, there are two very significant risks in the world today. And the first of those risks, the risks are not mutually exclusive. And the first of the two risks relates to COVID. Now, clearly, we have spoken about COVID time and time again. Everyone's well aware of COVID. But the issue with COVID actually fragments into two potential outcomes. Number one, we are stuck with COVID. We don't win. The vaccines aren't effective in any way. Or number two, everything's fine. We recover from COVID back into 2022, back into 2023. We solve COVID, or COVID goes away, or it actually evolves into a lower form of the current infection. The risk on the first side, of course, is clear. You don't have vaccination rates progressing at the same level throughout the world. If you look at the right-hand side on the slide, you can see that emerging markets are actually falling quite far behind. And as emerging markets as they not vaccinating their population, what you find is that COVID actually has the opportunity to mutate beyond the efficacy of the existing group of vaccines. And as a result of that, you might find that COVID is actually with you for a lot longer than expected. Or as I said, alternatively, if you fall into a different camp, you think we solved the COVID crisis, 2022, 2023. But if we solve the COVID crisis, we are then left with the second risk. And that is the stimulus that we have seen in the world over the last couple of years, and the excessive stimulus that has come to the fore as a result of COVID. What you're looking at is the US Federal Reserve's balance sheet going back to 1999. Now, pre-global financial crisis, the balance sheet sat at approximately $500 billion. As a result of the global financial crisis, we experienced QE1, quantitative easing, and the balance sheet went up to about $2.5 trillion. That grew again in QE2 to about $3 trillion. The Fed attempted to taper. That was the taper tantrum of 2011, 2012, and off the back of the markets not wanting to have any of it, the Fed increased its balance sheet again up to about $4 trillion. But what a lot of people don't realize is that the back end of 2018, the Fed tried to shrink its balance sheet. And in the last quarter of 2018, the S&P 500 actually declined from peak to trough by 18%. Now, it doesn't get spoken about a lot because it wasn't a bear market, because it didn't hit the magical threshold of 20% down. It was only 18% down. And once again, the Fed reversed course and they had to increase the balance sheet again. The balance sheet got close to about $4 trillion. And then COVID hit at the front end of 2020, and the balance sheet shot up to $7 trillion. And since then, the Fed has actually been buying bonds in the market by about $120 billion a month. We're sitting in excess of $8 trillion right now. Now, the stimulus can't remain forever. People are already worried about the inflationary pressures. But the problem, if you solve COVID, is what happens to the balance sheet, because the balance sheet has to shrink. And then ultimately, what are the implications for the market when global equities, specific global equities, especially those long duration global equities that aren't profitable, but there are a lot of high hopes for what will ultimately be achieved from those equities? What happens to those equities that are trading at significantly elevated multiples? So this is the other risk that we're worried about. Solve COVID and you are stuck with what you do with the balance sheet. Keep the balance sheet, and that ultimately implies that not all is right for the world and that growth is potentially still at risk. The ultimate solution is probably some sort of muddle through like we're experiencing right now, where COVID doesn't quite go away. The balance sheet sits where it is, sort of, but the Fed tries to at least reduce the number of purchases, and you get a little bit of inflation coming through the system. You get a bit of financial repression because interest rates are low, but ultimately what that means is governments across the world can grow out of the debt to GDP ratios they're currently sitting with, because debt to GDP is elevated off the back of having to counter the COVID crisis that we saw. What does this mean for a South African investor, though? Where does one actually allocate capital, given the risks, those two significant risks? Because over and above COVID and the balance sheets, of course, in South Africa, we're faced with the political issues, we're faced with a lack of growth. You see the tensions between the US and China. And of course, there's a lot of question marks over what does the US's exit from Afghanistan mean currently. And over and above that, you still have the issue with, well, China regulation and the fact that the Chinese Communist Party is very much entrenching its will on investors who are currently based in China or currently investing in China. When we look at what is appropriate for South African investor, clearly there's no growth in South Africa, and there hasn't been growth for a while. We last experienced 4.5% growth back in 2010, 2011, the red line. But by the back end of 2019, GDP growth in South Africa was down to 0%. So clearly, if a South African investor is seeking out growth, the best place to allocate their capital is offshore. And the best opportunities we're finding right now happen to be in high quality businesses that have pricing power. Because what matters about pricing power is, in a world where there's inflation and you have significant increases in input costs, you need companies who are able to pass those input costs on to their consumers. Alternatively, if you're in an environment where there's no growth whatsoever and you're not seeing an increase in demand for your products, you also need companies that have the ability to drive prices higher so that in the absence of rising volumes, you can still get rising revenue within the business. So we get very excited about that opportunity set, that offshore opportunity set that at least provides growth, GDP growth of 2 or 3% in some of the developed markets versus 0% in South Africa. Because you have to be very careful about assuming that the recovery that you see in 2021, the 4.5% GDP growth, and 2022, about 2.5% GDP growth is meaningful. Because all that does is effectively get you back to your starting point, the back end of 2019. And the question becomes, how do you achieve growth beyond that? There's no job creation currently. Policy is very much constrained. We need government to make real decisions in this country. But as a result of that inability to make decisions, to create jobs, to effect change in this country, we have a fantastic local opportunity. And that takes the form of government bonds in South Africa, because government bonds currently are trading on a yield of approximately 9.2%. That's the column in the middle. And most of that yield, in fact, let's say all of that yield in the 10-year right now, actually emerges from the coupon that you are able to receive from these government bonds. But of course, the question becomes, what happens if things go wrong in South Africa? You're trying to balance risk and return. Government bonds obviously offer a lot of return, but investors are worried about the risk. And so what we've done on the slide is we have plotted 9.2% as the current yield. And then we've looked at what happens if the yield goes up to 10.2% or 11.2%. Let's say we wake up tomorrow morning and the yields are at 10.2%. You make an immediate capital loss of 6.2%, as you see on the slide. But if you hold the position for 1 year, you get a coupon of approximately 4.6% every 6 months. Over 1 year, that compounds to 9.4%. And the combination of the 6.2% loss up front and the 9.4% gets you a total return of 3.2%. That's pretty attractive when cash is giving you 3.5%. If yields were to rise overnight to 2% over 1 year, you make a loss of negative 2.4%. Now, some of you might still question, well, what's the point of even taking the risk of the negative 2.4% loss? But if you are investing offshore, what bonds do in the portfolio, as I said earlier, is create balance. Because in an environment where bond yields have jumped overnight from 9.2% to 11.2%, the Rand will provide a massive offset. The Rand won't be trading at 14.5% if you see this, 14.5 if you see this increase. The Rand is probably going to be somewhere closer to 18.5 or even 20.5. On the right-hand side, you see the benefit if bond yields were to decrease. Now, we don't in any way want to suggest that bond yields need to be 2% lower, but if they were even 1% lower, you can make a return out of bonds of 16.1% over just 1 year. What really excites us about the opportunity, though, is this line at the bottom. Negative 2.4, 3.2, 9.4, 16.1. We like that asymmetry of return. And when constructing portfolios, you've got to think about limiting the downside while maximizing the upside. SA equities get spoken about a lot, and especially in the context of bond yields being high, everyone looks at SA equities and they say, well, valuations are cheap. They look at the green line, the forward PE ratio since 2005. The average is about 12.5 and the market's currently trading at 9.5. Of course, that must mean SA equities are cheap and one should be buying SA equities. But we're saying to our investors, be careful. Yes, historically, when the market was last trading here, 2012, 2010, 2006, 2005, you've made a lot of money. But if you look at growth in this country back then, in 2005 and 2006, real GDP growth in this country was 5.5%. In 2010, it was 4.5%. At the back end of 2019, it's 0%. And once you make it past 21 and 22, and you get back to your starting point of 2019, GDP in this country is going to struggle in terms of growth. And so we look at the current market and we say, well, if GDP growth in this country is effectively 0%, we actually need a bigger risk premium in local equities. You actually have to demand cheaper valuations, maybe 10, 20% cheaper from current levels. Putting this all together and thinking about this in the context of global equities, bonds, and SA equities, how are we thinking about those risk-adjusted returns? We've ranked the opportunity as we see it in terms of those risk-adjusted returns, and global equities represent the best risk-adjusted return to a South African investor right now, assuming you pick the right global equities. The way to read this chart, The midpoint gives you a sense of our expected return over the next 5 years, and the range gives you a sense of the risk attached to it. Global equities, best risk-adjusted return. SA cash, best risk, but absolutely no return. So we're seeking out that balance in the portfolio to enable our investors to navigate a variety of scenarios. Thank you so much for your time. Are there any questions?
Sumesh, perhaps we can sneak in one question before we go. Again, that was a lovely presentation that you gave. I think something that comes to mind is if we take a look at the medium-term returns, so say 3 to 5 years, they've been muted, and we've seen a lot of financial planners becoming or questioning that if the lower or medium-term risk prudential funds can actually achieve their targets of around 3 and 5% real above inflation. This would be, of course, over the relevant time horizon. Now, what would you say to advisors and their clients who have become skeptical to this?
Completely understand where they're coming from, but ultimately what they're referencing are funds that have had an over-indexing to South African equities. And over the last 5 years, South African equities that have not delivered because of a lack of growth in this country. Those funds that have had appropriate balance to global equities, to bonds, to even cash, given that cash was sitting at 7%, have done far better than that. So if you get that combination right, you focus on the underlying growth element, you will be able to deliver the 3, 4, and 5% real returns, because there are funds out there that have done it. And I don't know if I'm allowed to say this, but we are one of those funds.
Oh, you certainly are allowed to say it. Sumesh, I'm going to leave it at that for today. Thank you again so much for a really great presentation, very well thought out and really great insights there. Of course, that was Sumesh Chetty. He's a portfolio manager at 91. Of course, he was just giving us an overview of getting the optimal asset allocation mix in a multi-asset framework.